What's going on, fellow investors? Welcome back to the channel. It's your boy Sean from We Are Investing, a channel that is dedicated in investing and personal finance. Thank you for clicking on this video. On this video today, we are going to be discussing whether the S&P 500, the general market, is going to be breaking all-time highs. And there was a price target that was released out on the street today of $4,700 for the S&P 500 by the end of the year. The S&P 500 has already had a historic rise. It has been a crazy year for the overall stock market. We are moving up and to the right. The money printer is going burr. And money is being made in the market. And a lot of people are very skeptical as of late. It seems like September is changing people's mind. And some financial advisors, some people on YouTube, some people in the overall media, the talking heads are starting to switch their position a little bit because we've had some red days in the overall market.
I find things are so uncertain that I sit here and I say to myself, Mr. Market Rebellion, I want to rebel against this market because I just want to take a month off. Do you think that that's wrong?
But there is good things to talk about, and we're going to be discussing all those things in this video today. So the way we are going to do this video is I'm going to play a clip of some things that were said today, and then we're going to talk about what was actually discussed.
Because this morning you upped your S&P target for the end of this year, 2021, to 4,700. We're at 4,450 today. I'll take that gain.
Look, it's not a big upgrade. It's a small upgrade. We're talking about a few percentage points. I think the sort of the more important sort of message that we were trying to convey to the investment community was, I think the narrative, there's a lot of narratives. There's a lot of, call it, pessimism that's been sort of especially growing in the last 4, 5, 6 weeks. A lot of talk about late cycle dynamics, more structural, broader weakening. I think it's actually much simpler than that. And it's really come down to COVID and the fourth COVID wave and Delta that has resulted in definitely a delay in the labor market recovery process. Just look at leisure and hospitality. We're still missing about 1.5 million jobs there versus pre-pandemic levels. You have a bit of a negative impact on consumer sentiment on the back of that. And you've definitely seen a bit of a slowdown in broad-based economic and cycle data. But I think the view here, and the question here is really, what's the view on Delta? What's the view on COVID? Do things ease in the coming weeks, in the coming months? And if that's the case, I think everything we're talking about right now is displaced. I think we go back into some form of reacceleration and potentially a much healthier holiday season as far as 4Q is concerned, and a pretty decent setup when you think about the first half of next year. Just a few things. Cross-border activity has not even picked up. Very little. Tourism, nowhere to be seen. So again, are we completely discounting all of those? They will never come back? Or could we actually this time around start to see a little bit more of a broader easing wave in COVID that actually gets us closer to some form of more normal global economy and functioning? And then tied with that, the inventory cycle, which is at 25-year lows, CapEx cycle, which is at post-GFC lows, could they get a bit of a kickstart, right? So I think no need to get negative here on the cycle, no need to get negative on the consumer. I personally don't think there's huge amount of upside in the market. I think easy money has been made, and I agree that, yes, hard to get overly excited for on different parts of the market, but I do think that, for instance, the reopening theme, areas like cruise lines, I think risk reward is actually quite attractive and quite exciting, if you ask me, and I think some of these concerns are just wrong.
Now, that was an interview with Dubravko. He is the chief U.S. equity strategist for JP Morgan, which is one of the biggest investment banks in the United States of America. Now, he put a price target of 4,700 for the S&P 500 for the end of the year. That's over a 5% increase from where we're at today. And on our video yesterday, we talked about how the S&P 500, the NASDAQ, and the Dow Jones, all three of these indices, are approaching their 50-day moving average. And it's crucial for them to maintain that level because that level has been a strong support in the past, especially this year. There's been more than 8 times that the S&P 500 has bounced off of the 50-day moving average. And today was a good sign. We saw the S&P 500 move up around 0.8%, which is a big move in the S&P 500 for one day. Now, will this strength continue for the end of the week? I do not know. It's not enough to say whether the market's going to go up or down based off of one day's move. But the market has been bearish over the last 7 days. But even with that bearish activity over the last week, the stock market overall is only down around 2%, which isn't even in correction territory. These dips have been eaten up time and time again, and there is no reason to believe that this time is going to be different because nothing has really changed. And a key point that I want to talk about that we've been talking about for some time now is positioning yourself in some of these reopening trades. Maybe we are investing in everybody that's part of the community that's been doing these kinds of trades. Maybe we should be the U.S. equity strategist for JP Morgan because we've been talking about this for some time. But I want to point it out again. There is a lot of potential reward in some of these reopening trades. The way that I like to play it is pick companies that you like for the long term. Because if they dip, you will buy the dip and you will dollar cost average and build yourself a position for a long-term investment or a swing trade that's going to be many, many months. Do not look to try to get into a trade that you're going to try to day trade or swing trade in the next couple of weeks or the next couple of months because there is risk in the stock market. And with the reopening trade, we always have a risk with another variant or with the Delta variant resurging in the Northeast or wherever. Now, if you take a look at some of these stocks and why there is so much potential reward, it's because they've been beaten up a ton. If you take a look at Uber, we are at a great support right now, and it looks like this is a great time to add to your long-term position or open up a position as an investment in Uber if you like them long-term. I sure do, and I am adding to that position. You can also take a look at some other sectors that are reopening as well. Basically, all of the airline companies, they have been dipping and they are approaching supports. Maybe you get into a trade there. You can look at an ETF like Jets. Also, cruise lines. I'm not a huge fan of these because the balance sheet has been turned upside down. It's a very tough business to run. Those stocks are also approaching supports and they could rebound. The potential reward here far outweighs the risk in my personal opinion, and I think this is the exciting sector of the stock market. You put that in combination with some energy trades because if you take a look at crude oil, we are approaching all-time highs for Brent and WTI. And some of these companies like ExxonMobil and Chevron, the big oil companies, they have positioned themselves extremely well. And if you take a look at their charts, they've been beaten down. But it's not only the charts that matter here, because these companies also have juicy dividends. ExxonMobil is dividend yielding over 6%. Combine that 6% with the potential reward you get by playing the stock, that just adds another reason why I think the reward far outweighs the risk. Now, a strategy that you can implement with stocks that have high dividend yields like this and you own shares is you can sell covered calls and just collect premiums on these stocks because they're not going to move a ton in a given week. That you can sell weekly covered calls or you could sell cash accrued puts on where you think supports are, meaning that you don't think that this stock is going to dip below a certain level. You will sell puts at that strike price or a little bit below that. Give yourself a factor of safety. Collect the premiums weekly and just keep on bringing in the dough. For those reasons combined, I think that the reopening trade, betting on the U.S. economy recovering, that is where the potential reward lies. But there are good things to look forward to, and for that reason alone, it is not the time to be bearish in the market. Do not fight the Fed. The Fed is your friend right now. Trend is your friend right now. Until something changes, this market is still going to be bullish. Now, something for you guys to keep an eye out on, something to put on your radar is for next week. We are going to have a Fed meeting and maybe they start tapering and there could be an initial reaction. But just know there's ways to make money if they start to taper, because there are ways to make money on some of the things that will occur in the future. Be an investor, think about the future, think about ways that you can make money in the future instead of switching back and forth and not having any conviction in your trades, in your investments. Think for yourself instead of just following what the media wants to tell you on a day-to-day basis, because it can be left, right. And we're not trying to march into a graveyard. We're trying to be prosperous and own a graveyard. Maybe, I don't know. But I'll catch you guys on the flip side. It's been real. It's been fun. It's been real fun. And this is We Are Investing, mi gente. And together, we are invincible. Dale, hasta la próxima. Pow!
Se formó y ella se formó. Me encanta como yo. Este sabroso changüí.